Imagine for a moment that you're holding a digital dollar in your hand. It doesn't wrinkle, it doesn't tear, and it doesn't sit in your wallet or bank account. Instead, it exists on the blockchain, moving across borders in seconds, with no need for a traditional bank. This is the promise of stablecoins, digital assets designed to track the value of the US dollar, while giving the flexibility and speed of crypto. But here asks the pressing question. Between USDT, Tether, and USDC, USD Coin, which one is truly safer? The answer isn't simple, and that's why this comparison matters more than ever. To understand where these two giants stand today, we need to rewind a bit. Stablecoins were born from a tension inside the crypto world. On one hand, cryptocurrencies like Bitcoin and Ethereum offered decentralization, innovation, and the dream of freedom from traditional banking. On the other hand, their wild price swings made them impractical for everyday use. Traders, investors, and institutions needed something in between. A digital asset that held its value like the dollar, but moved with the efficiency of crypto. That's where stablecoins stepped in. USDT, better known as Tether, was the pioneer. Launched in 2014, it promised to peg every token to $1, backed by reserves. Tether quickly became the lifeline for traders, especially in the early days when moving real dollars between exchanges was slow and costly. For many, Tether wasn't just a convenience. It was the engine that kept crypto markets liquid. But from the beginning, Tether also carried whispers of doubt. Were the reserves real? Were they fully backed? The mystery surrounding Tether's transparency fueled countless debates and investigations, many of which still shape its reputation today. Then came USDC, introduced in 2018 by Circle and Coinbase through the Center Consortium. USDC positioned itself as the clean, fully regulated alternative. Unlike Tether, which operated in the shadows for years, USDC built its brand around transparency. It published regular attestations from auditing firms, worked closely with regulators, and presented itself as the stablecoin you could trust without hesitation. If Tether was the wild pioneer, USDC was the polished professional arriving to bring order. But history isn't just about origins. It's about how each stablecoin adapted to crises. In 2021, Tether finally began releasing breakdowns of its reserves after years of pressure, revealing that not all of it was held in cash and treasuries. Meanwhile, USDC faced its own test in 2023 when part of its reserves were stuck in Silicon Valley Bank during its sudden collapse. For the first time, USDC lost its 1-to-1 peg, dipping to around 87 cents before recovering. The message was clear. No stablecoin is immune to risk, not even the one branded as the safest. This tug-of-war between reputation and resilience is what makes today's comparison so intriguing. Tether remains the largest stablecoin by far, with a market cap exceeding $100 billion. It dominates global trading pairs, especially outside the United States. But USDC has carved out a stronghold in regulated markets, becoming the preferred choice for institutions, payment networks, and companies that want legitimacy alongside blockchain efficiency. The rivalry isn't just about two coins, it's about two philosophies. One thrives on sheer dominance and practicality, while the other leans on trust, compliance, and credibility. And here, as something most people don't realize, stablecoins aren't just about crypto trading anymore. They're creeping into remittances, decentralized finance, cross-border settlements, and even central bank digital currency experiments. Governments are watching them closely. Banks are cautiously integrating them, and millions of users rely on them without even realizing the potential risks underneath. If you've ever transferred money using an exchange, traded altcoins, or dabbled in DeFi, chances are you've interacted with one of these stablecoins. Whether you knew it or not, at this point, you might already have a favorite. Some swear by Tether's dominance and liquidity. Others refuse to touch anything but USDC because of its transparency. But the truth is more complicated, and the deeper we look, the more layers we uncover. The key question is not just which one is safer today, but which one is prepared to survive the future of regulation, global adoption, and inevitable financial storms. If this comparison is interesting so far, hit that like button. It helps us reach more curious minds diving into these financial battles. But don't get too comfortable yet, because in the next part, we'll go beneath the surface. We'll explore the technical strengths and weaknesses of both stablecoins, from reserve management to blockchain networks, and reveal the surprising vulnerabilities that could change the game overnight. So, which stablecoin do you think will prove stronger when we look under the hood? USDT with its dominance, or USDC with its clean reputation? Share your thoughts below, because your perspective might be the missing piece of this debate. Now that we've set the stage with history, it's time to dive deeper. On the surface, both USDT and USDC claim the same mission. One token equals $1. But how they attempt to guarantee that promise is where the story gets fascinating. The technical foundations, the way reserves are handled, and the mechanisms that maintain stability reveal both strengths and weaknesses that every investor should understand. Let's begin with USDT Tether. For years, Tether has been criticized for its lack of clarity on reserves. The company behind Tether insisted every token was backed one-to-one with dollars, yet regulators and journalists kept asking the same question: backed by what kind of dollars? When pressed, Tether revealed that not all reserves were held in cash. A significant portion was in commercial paper, secured loans, and other assets. This meant that while Tether was still technically backed, some of its collateral depended on the health of corporate debt markets and other riskier instruments. To critics, this looked like a house of cards. To supporters, it was simply smart treasury management, maximizing returns while keeping liquidity sufficient to handle redemptions. On the other hand, USDC came out of the gate with a different promise: full transparency. Circle, its issuer, pledged that every USDC would be backed by cash or short-term US treasuries, some of the safest assets in the world. Circle hired auditing firms to publish monthly attestations, showing where reserves were held. For institutions that feared Tether's opacity, USDC felt like a breath of fresh air. It wasn't just a stablecoin, it was a stablecoin wrapped in regulatory compliance and corporate polish. But here's where the plot twists. Transparency is not immunity. In March 2023, Circle revealed that $3.3 billion of USDC's reserves were stuck in the suddenly collapsing Silicon Valley Bank. Overnight, USDC depegged, falling as low as 87 cents before recovering when the US government stepped in to backstop deposits. For many, this was a shocking reminder that even safe reserves can face unexpected risks. Tether, which was often accused of hiding the truth, didn't flinch during that crisis. Ironically, the coin with the reputation for opacity looked more stable when the banking system itself cracked. Let's also talk about redemption. In theory, any user should be able to redeem one USDT or one USDC for exactly $1. In practice, it's more complicated. For Tether, redemption is limited to large-scale players with minimum withdrawal amounts, often tens of thousands of dollars. Retail users usually rely on exchanges to convert back to dollars. USDC, issued directly by Circle, allows more direct redemption, though with strict KYC requirements. This difference highlights a subtle truth. Stablecoins aren't fully decentralized. They rely on gatekeepers, rules, and the trustworthiness of their issuers. Now, let's look at the blockchains themselves. USDT is omnipresent. It exists on Ethereum, Tron, Solana, and many other networks. Its flexibility makes it incredibly liquid worldwide. In fact, Tether has found its strongest adoption, not in the United States, but in emerging markets where access to dollars is restricted. For people in countries like Turkey, Argentina, or Nigeria, Tether isn't a speculative asset, it's a lifeline against inflation. By spreading across multiple blockchains, Tether maximizes accessibility, even if that sometimes raises concerns about fraud or money laundering. USDC, by contrast, has focused more on quality over quantity. While it also runs on multiple blockchains, Ethereum, Solana, Avalanche, Polygon, and others. Circle has placed more emphasis on building regulated partnerships. USDC powers, payment systems, corporate treasuries, and even experiments with global remittances. Circle's collaborations with companies like Visa and MasterCard show that USDC is designed not just for crypto traders, but for integration into mainstream finance. Security is another critical piece of this puzzle. Tether has been accused of being slow to freeze assets tied to criminal activity, but it has still demonstrated the ability to blacklist addresses when pressured by regulators. Circle, however, is far more proactive. USDC has a built-in mechanism that allows Circle to freeze or even seize tokens at the request of law enforcement. While this might sound like a safety feature, it also sparks debate. Some users argue that this level of control contradicts the very spirit of crypto decentralization. Others see it as a necessary step to ensure compliance and survival in a world of tightening regulations. All of this raises an important question. Do you prefer the wild resilience of Tether or the clean compliance of USDC? Neither is flawless. Tether's opacity still leaves room for doubt, even as it proves remarkably durable in times of stress. USDC's transparency is refreshing, but it ties the coin tightly to the fate of traditional banks and regulators. In a way, choosing between them is like choosing between two different risks, one hidden, one visible. If this breakdown makes you think differently about stablecoins, share your thoughts in the comments. Your perspective matters. Which do you think is riskier, the shadow of uncertainty or the hard spotlight of regulation? And don't go anywhere, because in the next part, we'll explore adoption and future potential. We'll see how these stablecoins are shaping industries, powering global commerce, and even clashing with central banks. And one surprising fact might just flip your expectations upside down. Adoption tells us as much about a currency as its reserves. After all, what good is a stablecoin if nobody actually uses it? This is where USDT and USDC diverge sharply, painting two very different pictures of how money moves in the digital age. USDT has become the de facto trading currency of the crypto world. On exchanges across Asia, Europe, and Latin America, traders use Tether as their primary dollar substitute. In some countries, with strict capital controls, USDT has even replaced physical cash in daily transactions. In Turkey, for instance, locals struggling with inflation often turn to Tether as a way to preserve value. In Argentina, where accessing US dollars is notoriously difficult, many ordinary citizens rely on Tether as a digital dollar that bypasses traditional banking hurdles. For millions worldwide, Tether is more than a token. It's an escape route from weak currencies and unstable economies. USDC, however, has carved out a different role. While Tether thrives in the gray zones of global finance, USDC shines in the regulated corridors of mainstream adoption. Circle, its issuer, has partnered with Visa, MasterCard, and even banks to pilot payment solutions using USDC. Some companies are experimenting with paying employees in USDC, while others are integrating it into cross-border business settlements. Decentralized finance platforms, particularly in the United States and Europe, often prefer USDC because of its reputation for safety and compliance. It's not just a stablecoin for traders. It is a tool for building bridges between traditional finance and blockchain innovation. The competition, though, isn't just between these two coins. Governments are watching closely. Central banks from China to Europe are racing to develop CBDCs, central bank digital currencies. If a US digital dollar ever emerges, it could reshape the entire stablecoin landscape overnight. Would USDT and USDC survive such competition, or would they fade into irrelevance? Circle has openly stated that it's willing to work alongside a CBDC, positioning itself as an ally rather than a rival. Tether, by contrast, may face sharper scrutiny given its offshore operations and history of regulatory friction. Still, neither coin is without risks. Tether's greatest strength, its dominance and liquidity, is also its vulnerability. If regulators were to suddenly clamp down, or if doubts about its reserves triggered a bankrun-like panic, the shockwaves could destabilize crypto markets worldwide. Imagine billions of dollars trying to exit Tether all at once. The consequences would ripple across exchanges, decentralized finance, and even Bitcoin's price itself. USDC's risks are different but just as real. By tying itself closely to US banks and regulators, Circle exposes USDC to systemic risks in the traditional financial system. The Silicon Valley Bank incident in 2023 was a perfect example. Even a coin marketed as ultra-safe can falter if its underlying institutions stumble. Some critics argue that USDC isn't really a decentralized stablecoin at all. It's just a digital extension of the existing banking system, with all the weaknesses that system carries. So, which stablecoin is truly safer? The honest answer may be that safe is a relative term. USDT is resilient, battle-tested, and deeply entrenched in global markets. But it carries the shadow of uncertainty around its reserves. USDC is transparent, regulated, and trusted by institutions, but it depends heavily on the stability of the US financial system. Each one reflects a different philosophy of money. One thrives in global liquidity, the other in regulatory legitimacy. The future may not crown a single winner. Instead, both may coexist, serving different audiences and purposes. For a trader in Asia, Tether may remain irreplaceable. For a bank in the US, USDC might be the only acceptable option. Together, they embody the paradox of modern finance. Trust is not absolute. It's negotiated, contextual, and fragile. If this comparison has sparked new thoughts for you, don't keep them to yourself. Share your perspective in the comments. Which do you believe has the better chance of surviving the next decade? If you found this deep dive valuable, hit that like button. And if you want more explorations of the hidden battles shaping money, subscribe to Wealth Unlocked so you don't miss what comes next. Because whether it's Tether, USD Coin, or something entirely new, one thing is certain: the future of money will not look like the past. The question is, are you ready for it?